Inflation is high. The Fed is relentlessly raising interest rates. The economy is sinking into recession. Stocks have been in a bear market for more than a year. Banks are now failing. Let us review why this is good news for the financial markets and the business cycle going forward. I'm Bruce Frazier, your host. Welcome to Power Charting. Today, bonds have interest. Let's make the case for a new bull market in bonds and the importance of that to the economic cycle. And also, let's do a stock market update. Starting with the Fear and Greed Index, the CNN Fear and Greed has returned back down to extreme fear, which shows that across the financial markets, there's a tremendous amount of pessimism. This very much is related to the most recent news about the failure of Silicon Valley Bank and also other banks being in deep trouble at this time, which is truly an indication of how the Fed's raising interest rates has raised them to the point where it's effectively showing breakage in the system. And that often is a very important point in time in financial markets. Let's look at the S&P 500 and how that may be at work in the stock market indexes. Here we can see that there's been a decline from resistance down to this support area defined by the May low from 2022. So this we would describe as being the last point of support, potentially, and the last point of support is the last place it pulls back to before a more important rally begins. So that's why it's called the last point of support before the uptrend. Now, it could be that this trading range grows much larger from here. So this is a pure mental speculation on my part, but let's look at the case here. One is that we have a very oversold market, and this market, this is stocks above their 50-day moving average, and it is now down. It's dipped below 20%, currently at 23%. So that's a very low oversold reading. We would watch for divergences such as we saw at the September-October low and earlier, and we will keep an eye for that. The other thing is that very important support forms here in a couple of different ways. One is a preliminary support, which was the original stopping place in this very large accumulation structure, if it is accumulation. There's a big if here. And then the other part is it's returned back down after breaking above the downtrending supply trend line right here. It has come back to it from above, tested this area, and is slightly below the 200 and the 50-day moving average at this time. Notice today, very strong day, and this is off of a test of this key low. So this very high volume in here all occurred around the level of these important lows, this testing area. And so could we say that there is demand in this area? And demand because the volume is coming in at the location of the lows. We will watch for a continuation above the 50, above the 200, and whether or not it can return back up to the resistance area as defined by this 4100, 4350 area, which is a swing trading point and figure count. If it can do that and show strength, there's a lot of ifs here, and show strength up here and then pull back, this potentially could be accumulation. Why is that possible? Well, that is the topic for today. Let's look at the bond market. You've seen this chart before. This is the TLT. This is the U.S. Treasury bond ETF 20-plus year maturities, very long-term maturities. This is the 2021 high in turquoise, this area. We've counted this distribution area. A whopping decline was counted from a high of 152 down to 101 to 91. That's a massive decline in the very staid, normally stodgy bond market. And then it formed a redistribution across this area. Well, and what happened is that you had a confirmation of the redistribution to the distribution, and it set up these lows. I have put this in here. This is one of my Frankenstein charts. And so note that this low held very sharp rally up to this level, and now it appears that we're in some kind of a range-bound condition, as we would expect, off of a count low at this area. And also note that we have an oversold condition right here in a trend channel. And if we can continue to build cause in here for a more important move, this could be the beginning of an important bull market. So let's talk more about the possibility of that happening. And we do that by looking at this very wonderful 6 stages of business activity model that Martin Pring has developed. Martin and I, for many years, worked together in portfolio management. Martin developed this at that time, and it's really just, I think it's exceptional. It's a great tool. I want you to learn how to use this tool because it can help you immensely to understand how financial markets interact with business conditions and why it's so difficult for investors to be able to grasp how and when to buy the different asset classes. Today, we're going to break this down into 3 main groups, and that is the bond market, the stock market, and inflation sensitive, which I'm going to talk about in terms of the commodity prices. So we can see stage 1 through 6. Stage 1, you want to own bonds. Stage 2, you want to buy stocks and also own bonds because they're both in a bull market. Stage 3, as the economy starts to get better, you want to start to buy inflation beneficiaries. And so that is stage 1 through 3. Stage 4, the bond market goes on a sell, and this is largely because the economy is getting so strong that there's ever increasing demand for money to grow businesses, payrolls, etc., and interest rates start to go up in stage 4. Stage 5 is the very peak of the economic expansion, and when things just can't get any better, they don't. The stock market starts to discount a slowdown in the economy, and that is the top for stocks. Stage 6, the economy is already starting to slow, but it's still expanding at a lesser rate, and that is when you want to look to sell commodities. So buy bonds in stage 2, own bonds and stocks. Buy bonds in stage 1, own bonds and stocks in stage 2, own all 3 asset classes in stage 3, sell bonds in stage 4, sell stocks in stage 5, sell inflation hedges in stage 6, and this cycle goes on and on and on. Let me make one brief point here in this chart, why this is so difficult for people to be able to really get their heads around. It is because look at stage 2. When you get below this neutral line here, below this is recession, above this is expansion. The economy is not only is it at peak recession, at the bottom here in stage 2, this is the point when the news just can't get any worse. So the stock market, interestingly, is always discounting the future. It's looking ahead, and stocks are cheap. They've been in a bear market in stage 2, and when things just couldn't look any worse is when all of a sudden stocks start to act better. Well, right now, people think things look pretty bad. We just saw the CNN Fear and Greed. It's down in the fear section. We're looking at the economy. It appears that we're going to have recession in the second half of 2023. So the economy is weak and getting weaker. We have the stock prices are quite low. We just looked at the S&P 500. Potentially it's building a base and trying to build an accumulation, but it may have to have another leg down. the thing is that things don't look great. Interest rates are super high, and we're starting to have trouble in the banking system. Now, those are all conditions that could be favorable to the bond market, and we're going to focus really on the bond market today. So the bond market is our topic. We're going to ask the question, are we in stage one? And is this a time to start to look to buy bonds? Well, let's become tape readers and get back to our charting. And so this is really a study that goes back to 2017. The bond market here is on top, bonds, then stocks, then commodities. So here are our three asset classes where we are focusing attention on this model on the right. And so the bond market, we can see in 2018 made an important low. These are bond prices. So bond prices made their important low. We know that's the first thing to happen in stage one is that bonds make their low and then they start to turn up into a new bull market. And that is exactly what happened here. And then following that, now there's some debate here, and there's always the case when you're looking at the economy, is the important low December 18. Now, October 18 for bonds made their low. December 18 was stocks. Well, this low began a new bull market run, but then was interrupted by the COVID event. And the COVID event then actually accelerated the expansion, but went to a slightly lower low. So it could be that we could argue that stage two began in March of 20 at the COVID low. Then in April of 20, a month later, the commodity market, as we define it here by the CRB index, is making a low a month later in April and begins its bull run. So here we have stage one, we have stage two, either here or here, stage three is here. So we are in, and this green shaded area represents when all the asset classes are in an uptrend together. Bonds top out in 2020. This is where we put the number 4. This is the top for the bond market. And then the bond market turns down and begins its primary bear market. So this is where we are, stage 4, not now, but at that time. And that was June of 20. So we would then watch for, at some later date, for the stock market to top out somewhere consistent with the top of economic expansion. And in fact, the stock market topped out here in December of 21. And that was the top for most stock indexes at that time. So that puts us, we have bonds on a sell, stocks on a sell, but inflation hedges continue to be able to go higher. So that is, as we see here, this is the point that we sell. This means that we're in stage 5. Bonds on a sell, stocks on a sell, inflation still on a buy. Stage 6 comes in May of 22 when the top is in for the CRB index. So now we have a stage 6 environment, and something very important happens in October of 22, and that is, and this is right here, is note that a very important low came in bond prices. That is the high yields for bonds, and it's the low prices. So is it possible that the new bull market for bonds actually started in October of 2022? And so I'm attempting to make that case today, that that is in fact where we are, and that we are starting a new cycle. Now, this means the economy is going to continue to get weaker for a while, but bonds are in an uptrend, then stocks will be in an uptrend, and then inflation hedges, and the cycle starts anew. So this is our topic. Let's move on and look at what happened with U.S. Treasury 10-year yields. We just looked at prices, but now let's look at yields. This is back in 2020 and daily chart, very large structure here, very volatile. This is interest rates, but we can do analysis on interest rates as we can on prices. So we see here that the low for interest rates on the 10-year is like 0.4%. I mean, it's just super low. It's nearly zero. And then a very sharp rally up. And this is called an automatic rally in Wyckoff. And this rally is very sharp. It takes us up above 1%. And it settles into a range-bound condition with ever diminishing volatility. So it's low. This is like about 0.5% in here. This is 55 basis points, 60 basis points, very low. And it just stays in this area. But what this very sharp rally and these series of tests have shown is that some kind of an accumulation structure is forming for a new increase in interest rates. And boy, what a big increase in interest rates we got. So here, still under 1% at this area, goes to resistance, forms a wedge, jumps out, backs up. This is a very vulnerable place for higher prices or higher yields in this case. So now let's look at things currently. This is the same 10-year Treasury yield index and see the distribution. I'm going to show you the point figures on this in a minute. But see the distribution that formed in 2018 and 2019. This is distribution that signals lower yields. This is the area that we just evaluated. We're looking at weekly data now. And so this is the area that we just evaluated on the daily chart. So you can see that it still is substantially volatile at this area with a return down to 0.4% and in the area of 1% through this whole period. Very important sign of strength here, and then a backup, and off it goes into a new important uptrend. This is the ultimate and final high. Let's look at why this could be the final high for 10-year yields and that they could be coming down going forward. Look at this trend channel. So we have a very important point here and here. They're approximately equal in extent and duration. And we connect those, and we have a trend line that works exceptionally well throughout this upward trend. It's able to dip below slightly and briefly below this demand line, and then it takes off again and continues its rise to higher yields. So here we draw another trend line on this high, and this is giving us a wedge type structure. Well, when we see a wedge like this, this tells us that we have diminishing momentum in the upward move. So the first move up was 257% from this low to this high. So that's the sort of the first wave up. The second wave up is very intense. It's up 208%. And so it's less than the initial wave, but it's still quite substantial. And then finally, a little hard to read here, this is about a 74% advance, but each one of these thrusts is diminished. And you can just look at it from the high up to the next high, to the next high, and you see these diminishing thrusts forming. That's a sign of loss of momentum. Now, an important break of the upward trending, effectively, this is a demand line. It breaks down through this area after a sharp decline and then rallies up to the underside of it. And now look at the volatility in the drop off of this touch. And this touch is a test of the high. This is a particularly vulnerable place in the construction of a high, is a test because it shows that there's literally little to no demand for, in this case, and yields are able to fall easily. So this is one of our cases for why we have falling interest rates ahead and rising bond prices. Point and figure counts. The left chart is the historic period 20. Here's our distribution top. And this is 10x, again, 10-year yields. We're doing point and figure charting of this. This count here goes to the area of a redistribution that forms at about 1.5% down to 1.1.5% right here. So the yields are becoming quite low after being as high as 3.2%. So down it goes, catches this low right here, redistribution. It cannot really get going again. The downward trend's in force, and then look what happens on the conclusion of this redistribution is this incredible decline that goes from about 1.85% down to 0.4. That's an incredible drop. And this count here captures this climactic low, which we just evaluated on the vertical chart with the structures that we identified on the weekly and the daily chart. Now, let's go to the present here on the right and note that this area, we changed the scaling a bit, 7.5 basis points, 3-box reversal method. This is the accumulation area that we just looked at on the vertical chart. And as you see here, this count takes us, and a beautiful count, and it takes us up to, from this last point of support area, 1.35%. It counts up to the high box, 4.27%, 275. And so it absolutely perfectly touches the top of this upward stride. And see, the stride is formed here and here, and then it holds the stride all the way up as we saw in the vertical chart. And at the final conclusion, we have an upward thrust that takes out the top of the channel, pulls back all the way to the demand line. Another big thrust up takes out the top. This is overbought and a throw over, a classic condition that we do trend analysis with the combination of a point figure count objective. Really impressive. So that is what happened. Now we're building distribution count. Now, when I say distribution, this is distribution for lower yields. Lower yields convert into higher bond prices. And we have a count now. So I'm making news with this because this chart here suggests that we are actually have the potential. We can't tell how long it'll take. Could take a long time. But that interest rates on the 10-year yields could fall somewhere in the future, and this count could grow larger. It's actually at support. Yields could go up some from here. But it's building a cause and a count, and look at this big sign of weakness, down to 2.25% to 2.02%. So from the area currently at around 3.5%, slightly below that today. And so that's still a substantial decline in yields from this area, as this is still looking distributional and may even build more count. So this really does have a compelling case for lower yields going forward, and is further case in our analysis of why we're in stage 1, and that we could very well be in stage 2, which is buy stocks in the summer to fall, because that is likely when we're going to see recessionary conditions in the economy, and probably very mildly recessionary from here. But it's probably going to create some additional fear. And so keep this all in mind, and do join us, because we talk about all these markets at Wyckoff Analytics, Wyckoff Market Discussion, Ramon and I, and it's a lot of fun. This is a free episode. Absolutely, we do not share your data with anybody. So sign up and join us. And then finally, this is the last chart of the day with the minute that I have left. This is crude oil. So here is one of the very important commodities that is in that commodity index. Note the high. This blue box was our point and figure count that we had off the accumulation structure at much lower prices, threw over the top of this channel, tested it, fell back in. We've looked at these charts a number of times in the past, rode along the underside of the channel and then just melted away. And now we see here that an important break down below the support area at $70, 67.61 as of yesterday. Here is a swing trading count. We fulfilled this count at $69 at this area, and it's attempting to rally today. Then there's a bigger count that goes down to as low as 58 to 60. So there is pressure on these key important commodities. And with that, I thank you so much for being here, and we will see you next time on Power Charting.